All right, real quick. What's up, everybody? Stocks by the numbers. Welcome back. Wanted to look at two names here reporting earnings after the close. I'm trying to do this real quick so I can upload it quick and you can see it quick, and everyone will still have, whatever, 30, 40 minutes, hopefully, to see this before market closes if you want to take a position. First company I'm looking at, Dave & Buster's Entertainment, ticker symbol PLAY, listed here on the NASDAQ. Stock's trading 61.83, down 2.6 right now, a little over 4% here on the day. Recently hit new 52-week highs for reasons unbeknownst to me. If we come back, we look at earnings, we can see a beat on the EPS side, miss on the revenue side. The stock went up about 50% from that point. The quarter before, huge miss, top and bottom lines. Stock consolidated and then broke higher for reasons unbeknownst to me. We go the quarter before, we can see beat on the EPS side, another miss on the revenue side, 3 quarters in a row. But for some reason, the stock went up from 32.5 and actually hit over 47 on a miss. So I just have to laugh at these situations. This is a one-year chart, by the way. Boom, one-year chart. You can see this stock went from the mid to low 30s up to as high as $65 a share. So we're looking at roughly a 100% move over the last 12 months on a company that missed on revenue for the last 3 straight quarters in a row. We have a market cap of about $2.5 billion. The PE sitting here at 23.7. On the EPS side, in my opinion, that really doesn't seem to be the issue because they keep missing on the revenue side. So we have 3 beats out of the last 4 quarters on the EPS side. Very nice. We can see the quarters here kind of go up and down here with Dave & Buster's depending on the time of year. But Q4, this is Q4 coming in. You can see Q4 usually sees a bump up in revenue from Q3. And we can see last quarter, 467 million, we'll call it. And we can see estimates now up to over 602.6 million. So that is what? 7-8% growth here year over year, and in my opinion they've been consistently missing earnings, so technically even if they beat earnings, in my opinion, they should drop back down to the 40s. That's the way I'm looking at it, but again, that's just me personally. But switching over here, you can see the company, they were missing, then they beat a handful of quarters in a row, and then they missed a handful of quarters in a row, but yet for some reason again the stock is up. And that is why I say, in my opinion, these overinflated, random bull run, record high markets that we go into, in my opinion, are extremely dangerous. Because again, you have a company supposedly that goes up even when the numbers are bad. It's up over 100%, so everyone's probably looking at this saying, well, even if they miss, the stock's probably going to go higher. But then we have a big pullback today, and you can see the stock's taking a 4% hit with earnings coming in about an hour. Now, usually we see when people are anticipating these earnings, you'll see a little bit of momentum. You'll see a little bit of a run and a rally come into the stock going into these earnings numbers. However, this stock being kept down roughly 4% basically all day. So what I'm saying is, like I always try to warn you guys, in my opinion, is to be very careful buying stocks up here when markets are at highs, especially, in my opinion, if they don't deserve to be at highs, because all you need is a couple of big red days and all of a sudden you're losing 4, 5, 7% a day, just chunking downward. And in my opinion, it is justified. The stock has gone from the mid-30s to the mid-60s while missing revenue 3 quarters in a row. Think about all the companies we looked at, and if they missed revenue 3 quarters in a row, I'm sure you'd agree that the stock would be down and not up. So it kind of throws me for a loop here, but in my opinion, even moving forward, you can see we're kind of stagnating here. I don't know. Overall, like I said, I'm personally not impressed with this situation, and I would probably play puts on PLAY. And you can see actually even coming out of the lockdown, 1.91 billion in debt for 20, and then 1.75 billion in debt for 21. It actually went down. And then boom, it just explodes up to almost 2.9 billion for 22. And if we look at the last couple of quarters, we can see, first of all, in the middle, you can see free cash flow, positive almost 4 million, 70 million, 40 million, 20 million, negative 3 million. And also the cash as well. The last bar here, you can see 108 million, 181 million, 91, 82, 64. So the cash has been dropping. The free cash flow just went negative. The debt, though, has been climbing. 287, 286, 288, 294, 294, maintaining 294. So in my opinion, these are all red flags. We have short-term liabilities outweighing short-term assets. The company used to pay a dividend, doesn't pay a dividend anymore. In my opinion, massive red flag. And again, people will probably say, well, there was the lockdown, they had to stop okay, fine, totally understandable. But now supposedly they reopened, and you can see, look at that jump up in revenue, right? Going back to 1.3 billion, basically where they were before the lockdowns took place. And now, as of the previous year in 22, almost 2 billion in revenue. So if the revenue is coming in and rebounding even faster than what they were bringing in before the lockdown, then in my opinion, they probably should have reinstated the dividend. But the profitability obviously took a hit. And more importantly, we can see also, look at this growth in assets compared to liabilities here. We go back to Q1 of 22, you can see 2.44 billion in assets. Jumps up to above 3 as of last quarter, 3.7 billion. Liabilities 2.09 billion up to 3.49 billion. So we're talking roughly a 75% increase in liabilities over the last roughly 18 months, while at the same time you can see a growth in total assets of just around 50%. So it seems like, in my opinion, the growth of liabilities is outpacing the growth of assets. And what does that mean? Well, that means total assets minus total liabilities yields total equity. And the equity, you can see, was at 350 up to above 400 million, back to 350, down to 314 million. As of last quarter, 211.6 million. What does that translate to? That translates to a lower book value, as you see. 7 and change up to almost 8.5, down to 802, 732 as of last quarter, 526. Now, I don't know about you, but any company who just missed earnings estimates for 3 quarters in a row shouldn't be trading 11, 12 times book value. But hey, that's just me, the way I'm looking at it. Also, if we switch over here, we can see the PE sitting at 23.7. That is significantly higher than where the stock was traditionally trading here over about the last 7 or 8 quarters. Price to sales sitting at 124. That level not seen since going back to Q1 of 22. But again, during that time frame, liabilities again have increased and the debt has gone back up now, touching almost 3 billion, right? So this is what I mean. I feel like this company is being rewarded simply for the fact that the markets they were. Today, obviously, we're down, but markets were basically raging for no reason, in my opinion. And this is what happens. This is, in my opinion, a very dangerous situation. Because, again, usually people are pumped about earnings, and, on a red day, that's it. The stock takes a 4 or 5% hit. So, in my opinion, I mean, it's a little simplistic of an analysis, but in my opinion, that actually shows me that the stock is probably overvalued, and I think Wall Street knows that as well, in my opinion. Price to cash flow sitting at 6.5. That is actually higher than where we were in Q1 of 22. Price to book, 12.25 times book value. Look at where it was. Look at the ratio before this current valuation here. It was half, less than half, almost a third of where the price to book ratio currently is. So in my opinion, this stock is tremendously overvalued, and I'm honestly really not sure as to why they're pumping it. But return on assets is down. Return on equity making a comeback, but is down. Invested capital, same thing. Look at the gross margin percentage here, down almost 50% quarter over quarter. Usually we see margin percentages drop, the stocks take a hit, but for some reason this stock is up. Operating margin percentage is down roughly 66% quarter over quarter, 75% from 2 quarters ago, yet for some reason the stock is up. EBITDA taking about a 40% hit here, going from the 29 and a third percent mark down to 24 and a third, down to 16 and a third percent. And the net margin percentage was almost 12%, drops down to sub 5, now sitting at negative 1.1%. So in my opinion, aside from like this rise in the inventory turnover, I am personally not seeing any reason as to why someone can tell me that they're bullish on Dave & Buster's. So in my opinion, I would do puts on Dave & Buster's. And if we look at stock charts very quickly, we can see RSI in the daily, middle of the road. Look at this rage here again, missing on revenue this entire time. And that's why I think, in my opinion, even if they beat earnings, the stock should pull back to about 46 right there. 45, 46 in my opinion. 200-day moving average on the daily, 46.08. I think that would be a good mark. I think, in my opinion, that would be more realistic as to where the stock should be. But on the weekly here, you can see a potential post and a bull flag forming. So who knows? The company may miss on revenue again, and they may take the stock up to $75, $80 a share. Who knows? But in my opinion, it really should come down. And this 50-day moving average on the weekly as well, just a touch below $45 a share. That's why, in my opinion, $45, $46 a share for PLAY. I actually think it's justified. Cal Maine Foods actually has been kind of bouncing around and inconsistent as well, but the difference is this is a food stock, and obviously that's technically a defensive company. Defensive company means that traditionally, usually, the company is able to maintain or potentially grow its business, even if the economy and the markets are a little rough. But that should not be confused with defense stocks like General Dynamics, Lockheed Martin, Raytheon, right? Those are defense companies. Defensive are stocks like Hershey, probably, and I have an ambulance going by, of course. So we have stocks like Hershey, in my opinion, and my apologies. We have stocks like Hershey. We have stocks like Philip Morris, right? Regardless of what the economy or the market's doing, up, down, or sideways, you know, if I'm a smoker, when I run out of cigarettes, I'm going to go get another pack of cigarettes. So that's why certain sectors are considered defensive. And in my opinion, I think food is a defensive sector. And I'm sure some people will debate with me, depending on, you know, higher interest rates, or, you know, I'll look at a stock like Hershey and they'll say, well, cocoa prices have been climbing, so they might take a hit. It's all understandable. But usually over time, food stocks do very well. Just quick mention of PPC, Pilgrim's Pride. That is a chicken company, a poultry company that I mentioned multiple times on this channel from about 26, 27. I think I did an update at like 24. I spoke about it again at like 22. I mentioned it multiple times in the Discord over the last several months. And that was a company that is not a brand name that a lot of people probably didn't know and wouldn't have put their faith in. And that stock today broke above $35 a share and is hitting new 52-week highs at levels not seen since November of 2017. So like that old adage says, sometimes good things come to those who wait. That's why I say, in my opinion, the bulk of your capital should be investing into stocks like that you find fair value or undervalue, and you see growth coming over time. That, in my opinion, is how most of your capital should be played and acquired. If you want to take, 5-10% of whatever capital you have, and you want to do some earnings plays, or you want to roll the dice on some speculative options to try to make, 300%, 500%, it's entirely your own prerogative and very understandable. I appreciate the fact we want fast results, we want quick money, but again, if I basically brought you back in time and told you PPC's at 25, there's no reason why it's not going to go to 35 over the next several months, then chances are you would have taken a chunk of capital and you would have accumulated shares and you would have secured the growth and appreciation over time. That's why I always say, in my opinion, it is much better to work smarter, not harder, right? It's very difficult to time what a stock is going to do this Friday. So if you buy a call option, it's extremely speculative. But if we just look at a company and say, oh, it's undervalued, it's probably going to go up in time, then we just simplified it, right? All we have to do is accumulate shares every chance we can, and over time, it will probably benefit us and make us decent returns. But went off on a tangent there. So Cal Maine Foods, CALM, 5841. And again, I know it's a food company and the numbers have been bouncing around, but in my opinion, I'd probably take a shot. I'd consider calls on CALM. Market cap, $2.86 billion. Slight dividend yielding less than 1%. Stock's only trading 6 times earnings. And again, this was something similar that we saw with PPC. And it seemed like it was a potential value trap. It seemed like they were keeping the stock down. It's not that active. Maybe it's not going to grow. And again, I looked at it at 22, 24, 26, and now the stock has recently been hitting 33, 34, 35. So, sometimes it takes time, but very low PE in my opinion. I mean, we can easily get that to 9 or 10, which would translate to roughly a 50% climb here in stock price. But of course, we have to see. The EPS side has been struggling for Cal Maine Foods here over the last couple of quarters. As you see, again, 2 misses, 2 beats over the last 4 quarters. EPS now $2.45, and we can see this time last year, $6.62 they posted. So taking a very, very big hit, but if you're able to come in above expectations, then you're going to get rewarded, right? And we have another situation similar to Dave & Buster's almost here, because a little less inconsistent. Yeah, see, beat on revenue, miss on the EPS, but Even over the last couple of quarters, something like Cal Maine Foods, look at this, miss on top and bottom line, miss on top and bottom line. The stock went from 47 down to 42, and then ran all the way up to 62 and a half. So, in my opinion, though, I think a company like this is reacting that way because it's undervalued. And I know you're going to say, well, you just crapped all over Dave and Buster's. How can you say that? Well, I'm going to show you, because if we come down here, first of all, we have a company that reinstated the dividend recently. We also have a company that is holding $360 million on cash and cash on hand that's been climbing consistently for the most part, quarter over quarter. And look at the debt. There is no debt. Look at how much assets are outweighing liabilities, both in the short term and in the long term. This is why I say, in my opinion, fundamentally sound stocks are the ones that should be rewarded, in my opinion. So that, in my eyes, is the main difference between this and Dave & Buster's. Because again, I understand they just missed earnings the last couple of quarters, but they're up as well. But looking at some of these metrics, I just feel like almost regardless of what the company reports, they're probably going to climb up, just because, in my opinion, they're significantly undervalued. But you can see, going back here, about 18 months, Q4 of 21, assets, $144 billion, now almost $2 billion. Right? So that's about a 33% increase. But if we look at the liabilities, they went up, they went down, but we went from 333 million to about 343 million. So the rate at which assets are growing is nowhere near the rate at which their liabilities are growing. And again, assets minus liabilities yields total equity. And you can see, look at the equity consistently stepping up. 1-1, 1-2, 1-3, 1-5, 1-6, 1-6, 1-6-2. Which obviously translates to higher book value, right? 22 and a half, 24, 31, 33, 33, 20. So that's why, looking at it like that, in my opinion, this company should be rewarded over time. Which is why, again, I know earnings are a gamble and anything can happen, but in my opinion, I would consider CALM calls and puts on PLAY. The PE sitting down here, single digits. You can see how low they've been keeping it down for the last several quarters. It was higher. Price to sales a little over 1. It was sub 1. It was at 1.2, 1.3. So I guess you can say middle of the road. Price to cash flow dropped down significantly to 2.6, and now has been slowly rebounding back up to almost 5. Trading 1.7 times book. Again, back here, we were a little over 2 times book. And again, 2 times book here would be new 52-week highs, would be about 66 and a half, almost $67 a share. But in my opinion, over the next 6 to 12 months, this should easily be, I think it should be 50% higher in my opinion, which would be what, 29 points on 58 would be $87 a share. So in my opinion, just conservative price target, I personally would give this about an $80 price target on CALM. Our return percentages were down. We went up. We went back down a little bit. We're down. We're down. Gross margin percentage took a big hit. Rebounded almost 100% though. Very nice. Operating margin fell all the way down from 40% to negative and then rebounded to 6.5%. EBITDA, same thing. It was above 40, drops down to 2%, but exploded last quarter back up to north of 10%. Net margin was above 30, drops almost down to flat, and now rebounds to 3.25%. So we understand hyperinflation and rising food costs. So I appreciate the fact that it's been eating away at this company's profitability, but again, in my opinion, looking at that, no debt, and again, minus these recent misses, the company seemed like they were solid as a rock on the revenue side as well. So this is why it seems like Q3 seems to be one of their bigger quarters, as you see, big beat there on revenue, big beat there on EPS. So in my opinion, it'd probably be worth the risk to consider calls on CALM. I would personally lean that way. But again, that's just me. It's just my opinion. Looking here on the weekly, I think we should break out if they do happen to beat. If they miss, it really shouldn't take too big of a hit, in my opinion. But I guess it depends on how much they miss and what they forecast as well. On the daily, top Bollinger Band almost 62. That, in my opinion, that's not high enough. I think, look at this stock over the months too. I think that I think that we pop up and we break out and we potentially touch, what was the high? 62.58. Yeah, I actually think it breaks above that. I think we may see potentially 65 plus, pending obviously on what the company reports. But yeah, I'm gonna end it there. So in my opinion, puts on play, calls on CALM. And if you're taking a position, I wish you the very best. But I'm going to end it there. So once again, stocks by the numbers. Thanks for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. More importantly, I want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.